Do you want to maximize your success with NCUA? Join Mark Treichel as he shares with you the insider's view on passing your exam with flying colors. The With Flying Colors podcast is sponsored by Credit Union Exam Solutions by Mark Treichel. If you would like to work directly with the Credit Union Exam Solutions team and receive support to optimize your results with NCUA so you save time and money, visit us at marktreichel.com to find out more.
Hey everyone, this is Mark Treichel with another episode of With Flying Colors. I'm excited today to be here with Bill Paton. Bill, how you doing today?
Doing great, Mark. Thanks for having me.
You got it. Yeah, you and I have chatted a little bit, discovered each other, I think, either over email or on LinkedIn, but I know that you've got a LinkedIn presence and you're the vice president at Alloya Federal Credit Union, and you and I chat a little bit about liquidity in some of our sidebar conversations on LinkedIn. I know you also do some things with subordinated debt and a few other areas, and I'm looking forward to chatting with you today about the interesting year we've had in 2023 in credit unions. How's that sound?
It sounds great, and it has been interesting for sure.
Yeah, it sure has. And anything else about Aloia on the front end? Anything from your resume you want to highlight in case my viewers aren't connected with Aloia? I know Aloia serves about 28-30% of the credit unions, so some of them are probably well aware of you. But any other things we should highlight on the front end here?
Yeah, we're a corporate credit union, so we're a credit union for credit unions. Like you said, we serve somewhere between 25 and 30% of the credit unions, depending on how many merged that year. And we serve them through the capital markets initiatives, which we'll talk about today, as well as the payment initiatives that the big piece going on this year, and all through our technology. Yeah, we're excited. Aloia is doing great things for its credit unions. Our tagline is, we support credit union success. So
I like it. We support credit union success. I think 2024 is going to be interesting in that regard because of some of the challenges we've had looking back and looking forward. But so let's chat a little bit about overall liquidity topics. What have you seen in credit unions and the clients that you have in 2023 as it relates to liquidity challenges? Obviously, we had the banks that failed and the aftermath of that. But even before that, there were some challenges liquidity-wise in credit union. What is it that you've seen in 2023 that you'd like to chat about here?
Yeah, 2023 was interesting. I say it was the year we collectively lost our minds. We're really back to pre-pandemic levels. And I think we're so quick to forget just even recent history. And a lot of what I do is talk to credit unions throughout the country. And of course, there's issues. And so during the pandemic, all that stimulus money came in and it was really good timing, and credit unions they had all this money and they had to figure out what to do with it. But we're back from an aggregate level. We're at really high levels, historically high levels. We're back to where we were right before the pandemic happened. If you just look at the overall numbers. But if you take like a deeper dive into that, those overall numbers are really spurred on by the large credit unions. If you dig into the different asset groups, different asset sizes, I should say, mid and small size credit unions do have a little bit of money, right? They're not feeling the same pressure that the largest credit unions are. Now, I don't want to say that they're not feeling pressure. They are. They have, deposits. They're fighting the deposit battle. They have to pay up for their deposits, and they continue to see high levels of loan volume. But in general, it's probably not as bad as maybe we're wanting to, the headline said. It doesn't mean that the top 20 largest credit unions aren't seeing really heightened liquidity. They are, but they're really driving the overall numbers. But if you took a deeper dive, it's not that bad now. I'll say this. I was chatting with a credit union that was maybe $200 million, and they were telling me that they're having a liquidity issue, and I said, okay, what's your loan to share ratio? And they said 60%. Okay, that doesn't sound like a liquidity issue to me, 60%. And they said, historically, we run at 50%. And so we're up. That's 20% over what we're up. And we're just not used to that. We like to be at 50%. Okay, that's a different problem. But I would say liquidity really isn't a major issue. So you're running a little bit higher. And so That's probably the same if we were to just have that conversation with most credit unions, regardless of size across the board. It's probably the same answer we're going to get. They're feeling a pinch, but probably not that bad. No, a couple
Right.
of
Yeah.
very large ones notwithstanding. Right? That's a different story.
Sure. It's a function of, okay, you got we're normally at 50% loan to assets. We're now at 60%. And what did they do with that other 30 or 40% during the last 5 years? Did they go long with investments, or did they keep it short? And how do they compare if you rack and stack them that way? But it's good that they're concerned about the liquidity side of things, even if it's that they don't have upside down investments and didn't go long and they're just wishing they had a little bit more cash. It's good that they're thinking about it, because NCUA clearly is hitting it and hitting it hard in nearly every exam, regardless of what asset size. So
I've been doing this for going on 18 years now. NCUA will always hit it, has always hit liquidity. It's always important. It's never not going to be important. Even during the COVID years, they hit it, right? Because, hey, when is the money going to come out? Those things. Yeah, it's always going to be at the forefront of the NCUA's mind, and should always be at the forefront of credit unions' minds. It's pretty good job security from that perspective. I say that knocking on wood, but it's fun to be in the liquidity space because there's always something, right? And I think more than anything, 2023, your point, right? Credit unions historically stay short in their investments. Again, there's some credit unions that have gone long, things of that nature, which have hurt. But in general, credit unions do a really good job of managing their liquidity comparatively. They stay short. Sometimes that hurts their net income, but that's okay. It's better for their liquidity. And so again, I think credit unions are a little bit better off than maybe even they'll say. If you get them off to the side and really have a heart to heart with them, they might say it's not all that bad. It ain't great, but it's not where it was in March of 2023 when we thought the world was ending and SVB was failing and all those banks were failing. It's tight, but we will get through this.
And along those lines, I haven't read it yet, but I saw another podcast that was talking about an OC guidance on what their focus is going to be on in 2024. And NCUA comes out with that mid-January for credit unions. But the teaser on the podcast that I want to listen to, and I want to read the OCC report, basically said they've shifted their top concern from liquidity to asset quality and delinquency. So that's a shift in banks. I'm very curious to see. NCUA has talked about that, and NCUA's chairman has talked about loan quality and concerns there. The trends in that, while the numbers collectively are not bad, the trends have been going in the wrong way, which isn't really a surprise. Sure. I'm curious to see what OCC has to say. I'm looking forward to see what NCUA has to say in that regard, which kind of gets us to a follow-up question. So 2023, we talked about what you've seen there. So so from where we're at, what do you see on the vision for 2024 for credit unions? And another way, where do you think we're going in that regard, in either liquidity or anything else on your radar?
Yeah. So I think liquidity will normalize a bit. I think it's going to be up, right? I don't think we're going to see an average loan to share ratio at 70% or 68%, whatever it was in 2020 or 2021. I forget what number it was, but it was down significantly. But I do think we'll get some ease from a liquidity standpoint. One of the great things that happened in 2023 is more and more credit unions got creative, right? In terms of how they get access to liquidity and manage their balance sheet. And the main thing that comes to mind is securitizations, right? And that's a hot topic seemingly every, month or every other month. A new credit union will come out with a securitization. I think there's been 9 of them or 10 of them in a recent industry publication. They talked about how they expect more to come, and we're seeing the same thing. But it's when times are tough, ingenuity and creativity comes, right? And I think we're seeing that in 2023. So securitizations, I think more and more credit unions will continue to go that route. I think more credit unions will continue to do interesting things. There is 2 credit unions in Texas. Right, they were doing a deposit swap, and that became a real big thing for a while. I don't know how if that will continue to be of importance to credit unions, but I just highlight those things to say credit unions will continue to get creative. as they need to manage their money in their balance sheet. And so what we're talking about right now, there's going to be a new creative solution that some credit unions will be bringing to the table in 2024 that we don't even know about. And I think more than anything, over the last 3, 4, 5 years, we've seen some real creativity across the board. And I expect that to continue to happen. So I expect more credit unions to issue securities or go through the securitization process. I think more and more credit unions will look for outlets to sell some of their assets as they continue to originate loans, right? I'm excited for it. I think it's great for the industry. It's very intriguing. It can only be good things for us for down the line.
Sure. Yeah. Those are, it's interesting. I've had some conversations with a couple credit unions that are now into securitization, and it's not super simple to do it. You've got to have a lot of bandwidth to do it. And there's groups out there that can help you with that. Is that something that Aloia particularly is involved with, or is that something that you guys can assist people with or point them in the right direction?
Sure. Yeah. So we're fairly plugged in within the industry, right? So Aloia is working on, I would say, a more scalable program for securitizations. So some of the big lists of getting into securitization is, right, you have to have your data correct. You talk to anybody involved with that. That could mean a lot of different things. But ultimately, at the end of the day, you have to be able to pull your data from your systems correctly on time to report to investors. So when you issue securitization and you're dealing with the FCU at that point, so it can be a little bit more of a constraint. The cost associated with securitizations is massive, for lack of a better term. And it's a great tool. It's an incredible tool for a handful of credit unions. And so I'll say this. I talked to a $300 million credit union last week about this because they were interested in, hey, we hear about this. We want to sell like $30 million into securitization. And I had to take 30 minutes just to give them a high level overview of this is what it entails. And these are the costs. $300 million credit union probably shouldn't be doing a securitization. And there's a lot that goes into that, but that doesn't mean that there isn't a creative solution that we can create that will allow for more credit unions to access that. And that's what we're looking at right now. We don't have a solution ready to come in and say, hey, give me a call. But that is something we are actively looking at and working on. But we're pretty plugged in with most of the players. And if you're interested in it now and you want to learn more, give me a call. I'll tell you all the players who's involved right now. Be happy to introduce you to them, and we can educate on that perspective as well. But yeah, securitizations will continue to be that. And as more and more credit unions do it, they'll talk to one another. They'll share good information with one another. So every new credit union that comes along that does it, it'll be an easier lift for the next credit. It's how those things work.
That's the beauty of how credit unions are truly cooperative, right? So they share that wisdom. And then as you're talking through that, I'm thinking maybe down the road, it sounds like a credit union service organization or QSO that might be able to help people pool and share the costs potentially. So
there's something there. We'll figure, somebody will figure it out. There's definitely
somebody will figure it out. There's a lot of smart people out there and like you said, out of crisis, new ideas are born as everybody was doing the loan participations for so long. And then the tide went up and the liquidity tightened up. That wasn't there. It made people a little bit tighter, and the securitization is a good option. Now, you mentioned deposit swaps. When I hear that, is that the type of scenario where you can double the amount of insurance because you're sweeping it over to another institution, or is it something different than that?
I don't want to opine on that just because I'm not an expert. I just remember reading about it thinking, wow, this is really cool. And I've heard of other ways around how credit unions are trying to get extra insurance or trying to skirt where they're taking in, I don't know, $1 million and then they're flowing off $750,000 to keep it. And I don't know if that's legit. So I don't want to give anybody bad advice here. Deposits are not my cup of tea. That being said, I thought it was super interesting. And so I just want to, I highlight that, go, hey, credit unions are going to do interesting things and they're going to continue to do interesting things because they have to.
Because they have to. Yeah, that's right. Very good. Another thing that in the long term potentially could impact credit unions, banks, life insurance companies is the recent 100-year report from the FHFA on the Federal Home Loan Bank system and the whole role that they play. I know that I interviewed Ryan Donovan, who's the head of the trade associations for the Federal Home Loan Banks. And there's acts that would require acts of Congress. There's acts that would require regulation changes by the FHFA. And then there's guidance that they could put out. But any thoughts on what you've read relative to that whole arena and how things move, how Aloia works with credit unions versus Federal Home Loan Banks or any intel there or thoughts you have on that whole arena?
Yeah. So like the FHLB, Aloia is a lender, right? In that regard. So all the corporates, I think there's 9 or 11 of us at this point, but all of us are lenders, right? And we're really an aggregator of deposits. And that's why we were created. And to my knowledge, I believe we were the first QSO, right? Like corporates were the first QSO. They were kicked out of banks and to go access the Fed and then provide liquidity. So to this day that we still hold those two truths. We just do those things a little bit differently. So just like the FHLB, we are a lender. What I would say is we are a lender basically on a day-to-day perspective. We can provide term lending and we do, and I think it's a great option. We have competitive rates most of the time, but we're not a federally guaranteed company like the Federal Home Loan Bank. So credit unions will say my rate is much lower at the FHLB. That's true because the cost of funds is essentially zero. And so to say all that, so Aloia is a lender, and that's one of our main components of what we do. We do it in a different way. In general, we do it on a day-to-day basis. So if you can't hit payroll or a large deposit came out and when you have an investment coming in the next week or two, you're probably going to borrow from a corporate. It just tends to be a little bit easier. FHLBs, from what I can see, generally, that's a little bit more of your planned borrowing, right? You need money for X amount of time. You're going to go to the FHLB, you're going to do that. Or you're going to take advantage of maybe some down rates at the FHLB and some up rates and then arbitrage opportunity elsewhere. That was a big thing for 2 years that credit unions did. All that to say, credit unions typically don't use the FHLB as an emergency source of liquidity, which if you look at the 100-year report, which you're referencing and all the stuff that happened with SVB and all the other banks, they were using that as an emergency, the FHLB system as an emergency source. So I do think that there will be some changes in how financial institutions can borrow from the FHLB. I don't know what that's going to be. And regardless, I don't believe how credit unions access the FHLB is the same way, is really what makes the FHFA worried. That being said, they're a community financial depository, right? They likely there's going to be some instance where whatever is changed through the FHA, it's going to play a part in how the credit unions access the FHLB. What that is, I don't know. I hope it's not much, but I am anticipating at some point something's going to change, and who knows what that is. Maybe they'll restrict borrowings in some way. I've heard, I didn't listen to Ryan's podcast, but maybe I've heard along the lines of they want the FHLB to go back to its original form, which was basically just for mortgage lending. That would have drastic impact on the industry if they did something of that nature, which would put more pressure on the corporates to be an even greater liquidity provider.
Yeah, that's a theme of that report for sure. So I think to me, the takeaway is it's good to have options. Life is about maintaining options and having a good relationship with the corporate, having a relationship with the Federal Home Loan Bank, the Fed, if your asset size allows for it, the CLF even. It's good to have options. And of course, the corporates being part of the cooperative system are always a great one to have in your toolbox for sure.
Sure. Yeah, the CLF is something that I don't think enough credit unions look at. If I were to sit here on the soapbox, though, I would seriously suggest looking at it.
I know that, I know NCUA would agree with you. And it's always on the list to get a little bit of regulatory change and small credit unions have some more liquidity challenges as that way that whole system is set up. And I know the corporates have covered for the small credit unions in some of the crises of the past and recently. Agree with you. The CLF's a good thing to check out to see if it makes sense for the individual credit unions. I don't recall the non-member deposits. Not non-member deposits yet. I know that they play a role. Is that something that Aloia assists with, or is that just a trend that you've seen in credit unions out there? Any thoughts on non-member deposits and how credit unions are used? Well, credit unions are utilizing non-member deposits as part of their liquidity tools.
Yeah, it's something that Aloia assists with. We are an owner in a QSO Primary Financial, which they have the Simply CD program. It is a massive piece of the liquidity toolkit. And one of the real cool things that we've seen, and this will be going into your question 10 minutes ago or 5 minutes ago, what do you see on the horizon? I see more assets going outside of the system. And recently what they've allowed this year is, and a little bit last year, was credit unions who issue non-member deposits who meet certain criteria to be able to hit the DTC market, which effectively allows them to go get other institutional investors in those non-member deposits. And I've talked to a lot of non-credit union investors over the last 3.5 years. Credit unions are wonderful for other institutional investors. They hit the ESG threshold that investors are looking for. So if you're a credit union, specifically low income designated, and you're not set up yet to access the DTC market, it's a great opportunity for you to go and do that. It's exciting in a couple pieces of paper, right? But now you're able to access this huge market of institutional investors and not just other credit unions, right?
And DTC, Insight itself, we were always really good at acronyms, but if someone doesn't know what DTC stands for, could you?
Yeah, it's Depository Trust Company. Ultimately, it's just a way, it's an acronym. That's the company that basically puts the QSIP on it. Again,
I got it.
Maybe I'm messing this up, but I believe it's the one that puts the QSIP on it and allows them to go and access the other institutional investors.
Got it. Makes sense.
I should know more about that. I a little homework for me after this.
There you go. As always, it's the sharpening the saw, the continual learning that those of us that love this industry, there's always something to learn. That's for sure.
Yep.
One of the challenges I mentioned in 2023, there are a handful of credit unions out there that reached for yield as it related to investments. And you gave an example of a credit union that's normally at 50% loan to assets and they feel a little tight because they're at 60. There are other credit unions that didn't, and there's banks, quite frankly, a lot of banks too, that maybe was a little slow at pricing their loans during 2023. And so especially if they maybe they had the parameters set with their loans they did, indirect loans, et cetera, and they had them priced and they were a little slower to change and move them up. And then they booked a little bit. Their loan to assets, let's say, went from 75 to 90 before they could turn the spigot off. And then delinquencies are spiking up a little bit. And those loans were priced for a market that was 200 basis points ago. Any thoughts relative to 2024, how people should be approaching loan pricing in conjunction with the fact that they might be, you said they're back generally where they were coming into COVID liquidity wise. Any thoughts on that arena from what you've seen and what we might expect in 2024?
Yeah. One thing that I think more and more credit unions are getting attuned to is liquidity management really is starting at the loan pricing. Like it's starting at loan origination. And to your point, Mark, credit unions were a little slow on doing that. And those that were attuned with the market, because liquidity, loan sales, whether it's participation or securitization, were a piece of their liquidity management toolkit, they had to reprice basically every day, which is a very smart way to go about doing things. More credit unions, regardless of size, are repricing their loans and being a little bit more competitive on a regular basis, which is great. So my advice to any credit union is to price competitively. And I get some pushback with that from credit unions, rightfully so, which is, hey, we're here to serve our membership. And if that means giving a car loan at $299, we're doing the best we can. And I would say you are, and that's great. And if your balance sheet can handle a $299 car loan for however long it's going to stay on, because it's probably not going to reprice or get sold off or anything of that nature, then great. Continue to serve your membership. You're doing exactly what you're supposed to be doing. But if you need to sell loans at any time, you need to understand where that market is. And so the best thing to do is follow those markets. And the loan sale market can follow different benchmarks across the board. The easiest way to do it is to just understand where the treasury market is and price somewhere around that for your consumer loans, right? Mortgage loans are going to be something different. Commercial loans are going to be something different. So wherever your benchmark is on your loans that you need to have fit, make sure you're following those and you can price your loans accordingly. As for anybody who's sitting on loans that are quote unquote underwater right now, that's a tough conversation. Does it make sense for you to sell loans at a loss? At what loss does that make sense? That is a conversation we have with credit unions every day, and one that we'll continue to have. And sometimes it makes sense, right? You can take that money, you can pay off some higher debt, you can reinvest it in another type of investment. You can make new loans at market rates, right? So you have to figure out what the best is for you, or you just sit on them, right? Most credit unions don't like taking losses ever. Most of the time they just sit on them. Conversation to have.
And it might be the right decision. It might not be the right decision, but it's it's like when you buy a stock and it goes down and you want to wait for it to get back to the price you paid for it. And it might never.
Sure.
But also that's the beauty of liquidity. High liquidity, you can manage your way through it as long as your asset quality holds. If you bought AAA treasuries that are just upside down because you went a little bit long, if you have the ability to hold, you'll get them paid back fully. And if you have the ability to hold those car loans, they'll do the same. That doesn't mean repositioning might make sense, like you said, because you can get the money out earning at a higher rate. And that's a lot of math that goes behind that. I do know that NCUA, and I've had conversations directly with some of the regional directors that they've told credit unions and they've told their staff, if someone finds themselves in that position and they want to purge a little bit of risk, which results in their net worth coming down a little bit because it positions them better for the long term, that NCUA is going to look very positively at the approach that looks at it in that light and is measured. But it is hard sometimes for people to say, hey, I took a loss on this, and they'd rather just let it ride at times.
Sure. Yeah, it's difficult. And that's the conversation that each credit union must have amongst themselves at a management level, could be even at a board level. In conjunction, I would say this, in conjunction with your examiner, not a bad thing if you can do that too, right? At least let them know that's coming if that's a decision that you are thinking about. Yeah, those are tough conversations, and those are done at an individual credit union level. I would never say what's good for one is good for everybody.
Sure. Absolutely. Absolutely. Bill, this has been an enjoyable conversation. I'm sure there's a question perhaps that I should have asked you that I didn't. Is there anything else you'd like to highlight here as we wrap up our chat today?
No, I think we're good. The quicker we can get off record and start talking college basketball again is always
That's
good.
right. Yeah. Yeah. We had a good chat about college basketball, college football, and even teeny tiny lakes in the Adirondacks that we were both surprisingly close history we have with both of our loves of the Adirondack Mountains in New York. Very good. Now, so Bill, if someone wants to reach out to you at Aloia, what's the best way for them to continue? If this triggered some questions they'd like to ask you, what's the best way for them to reach you?
Yeah, two ways. The quickest probably is LinkedIn. Like you said, Mark, I'm fairly active on LinkedIn, and you can look me up. It's William Paton. I'm the one at Aloia Corporate. I think that there's numerous William Patons out there, but I'm the one at Aloia Corporate. So that's my profile. You can shoot me a connection or a message is fine, as long as you're not trying to sell something. And then the other one is you can email me at Bill, Bil.Paton. So P-H-E-O-N. So Bil.Paton at aloyacorp.org. So ALOYACORP.org. So again, the easiest is LinkedIn after that mouthful. But yeah, you can, shoot me an email. shoot me a LinkedIn. Happy to connect however you want.
It's great. And I will put your LinkedIn profile, a link to your LinkedIn profile in the show notes. So if someone listens to it and goes down into the notes, they can find it there as well. Bill, I want to thank you so much for your time today. I really enjoyed chatting with you about all things liquidity and all things related to Aloia and what you're doing there to help credit unions. Thanks so much for your time today.
Appreciate it. Thanks, Mark. Have a great one.
You got it. And listeners, I want to thank you for listening again. I hope you'll listen again soon. This is Mark Treichel signing off with Flying Colors.
Thank you for joining us on this episode of With Flying Colors. Subscribe on your favorite podcast app to hear future episodes where subject matter experts of all varieties will provide tips on how to achieve success with NCUA. If you would like to learn more about how we assist credit unions, check out our services at marktreichel.com.